Let's mock up a scenario. We've got $500,000 in our superannuation fund, and we go to the fund provider and say, I'd like to start a transition to retirement pension.
Right.
That means we can take between 2% and 10%. And let's say, for example, you wanted all that money. So we can take $50,000 out of the account. We're over 60, so that means that money's tax-free.
Right.
We might throw some into our mortgage, park it in our offset account, for example, and then we can use some of the money that's come out to put it back into another super fund and claim 100% of that money as a tax deduction.
Okay.
So we're taking tax-free money out of your accumulated super by starting a pension. We're then getting that money in our hot little hand, and we're putting that money back into another super fund and claiming 100% of that money going in up to the legislated caps of $27,500, less what you've got from your employer. So some people may have $10,000, $15,000, $20,000 of what we call cap space.
Right.
So that would be the amount that you'd look to try and get out of your pension to then put it into another super fund and claim 100% of that money as a tax deduction